Great, thank you. Hi, everyone. So as mentioned, I'm Anthony Clark-Jones. I run the Strategic Ventures portfolio at UBS Investment Bank. I have the pleasure today of moderating this panel all about tokenization. So maybe let me kind of broad brush a bit of context before we get into some details. So look, I think as many present may well agree, tokenization holds the promise of seamless asset mobility, offering the potential really to transform how value moves across markets. And that is enormous potential. However, to date, I think that legacy infrastructure and just incumbent ways of working have perhaps constrained the adoption of new business models. So in today's panel, what we're going to do is we're going to explore the realities, the practical realities of trading across incumbent Tradfi and emerging financial business models. And we're also going to examine the challenges of achieving full interoperability and potentially reaching that frictionless, seamless move of assets across global markets. So in order to do this, and let me quickly introduce the panel. I have four leaders with us today in this space. On the end, Guido Stroemer, the co-founder and CEO of HQLAx. Emma Lovett, Executive Director in JP Morgan Markets with a speciality in digital assets. Anthony Woolley in the center, who is the Head of Marketing and Business Development at Onera. And next to me, Tobias Seidl, co-founder and CEO of STOKR. Okay, well, maybe to kind of set the scene, and maybe turning to all panelists to begin with, let's have some rapid fire opinion on why does asset mobility actually matter and who for? Maybe I can start with you, Guido.
Sure. Asset mobility to me encompasses a broad range of assets. Traditional assets, so sometimes referred to as fiat cash or fiat securities, or digital cash or digital securities. And the value proposition of being able to mobilize both types of securities or both types of assets is very, very large. The target audience for HQLAx currently are the large global banks, the 29 GSIBs, who together manage something like 25 trillion of collateral obligations across securities lending, repo, and margining. But over time, we expect the overall collateral management value proposition to expand to other types of clients as well, and specifically potentially to DeFi clients. So one really interesting use case that's been presented to us recently is for hedge funds and global family offices holding cryptocurrencies at a digital custodian looking to mobilize those cryptocurrencies to satisfy derivatives exposures at a crypto exchange. And much like in the traditional asset space, there is a value proposition around transferring ownership of DeFi assets without needing to move them from their home custody location to the end user. So immobilizing assets to enable ownership transfers of those assets to happen seamlessly without cross-custody movements or cross-wallet movements is as applicable to DeFi assets as it is to traditional assets.
Guido, thanks. And how about yourself, Emma? I mean, why for JP Morgan does asset mobility matter?
So I think from a high level, asset mobility matters in order to be able to respond to opportunities quickly. And I think that particularly around the topic of blockchain, it's thinking about how you can respond to events quickly, particularly in volatile markets. So people often talk about the financial crisis and around some of the events that happened sort of within 24 hours and thinking about whether the concept of being able to move assets in a quicker, more efficient way back in 2008 and 2009 could have maybe prevented some of the outcomes that happened then from happening again.
Yeah, super interesting. And potentially, Anthony, you could expand on, if we as a market get this right, what in fact are the benefits?
Yeah, Tremendous. So as well as being head of business development at Onera, I'm also the product owner for everything we're doing in repo and securities finance. It's what I've learned a lot about the last few years. And collateral mobility in the traditional finance sense has been hard. And we've had leaders such as Guido changing that with mobilization of collateral. If you can mobilize collateral instantly, and we've been working with Emma and Guido, we're now in production with bank-to-bank intraday repo, it produces tremendous benefits at an institutional level. So you could be talking to an institutional treasurer, and now they have tools where they can reduce size of buffers they need to meet their liquidity ratio requirements. They can still do that and avoid emergency funding. They've got idle cash intraday, and that cash can now earn interest. You get tremendous benefits at this large institutional level, talking to the treasurers in the largest institutions in the world. But once you can do that, once you can solve those problems of starting to mobilize collateral in a traditional finance sense, that feeds through from really those bank-to-bank infrastructures, which are the top of the food chain, for want of a better word, all the way down through to DeFi. So you start to do things like emerge intraday interest rates. There's only one interest rate intraday today, right, and it's 0. You can start to emerge that. You can start to provide solutions, institutional solutions to the DeFi problem, and Guido was alluding to that. If you can do it in a pure way, you can rehypothecate that collateral. It's tremendous benefits. It's a very exciting space.
Thanks, Anthony. I'm turning to you, Tobias. I mean, from your perspective, what from STOKR is going to help us kind of achieve all of this potential? Why does it actually matter for you?
So we are like in the tokenization space since 2018. So we have set up the company in 2018 with like the vision that all capital markets, financial instruments will be tokenized. And from this journey, what we have learned, because like when we started the company, everybody was still like asking these questions, why blockchain and the like, you know, and now we see like a tremendous shift in saying, okay, why are my assets not already tokenized? Why are my fund units not already tokenized? We are serving right now 1.8 billion on our platform, right? We are like by the largest, like the biggest tokenization platform in Europe, and probably second after BlackRock. Worldwide. And what we have seen, I mean, like when you think about transferability, I think like what we have seen is like different use cases popping up, because like the original idea was like, okay, we're providing like an infrastructure where we provide like how I call it, like a vertical connection between like an issue of an asset and the end investor, disintermediating all the silos which are currently in the legacy financial systems, and then of course you have like the horizontal layer where you can like transfer these, and transferring means not only liquidity, right? But what we have learned is transferring means also like you can use tokenized assets as collateral very easily. We have built like a beautiful machine around for hedge fund managers here in London, where we said, okay, what is your need? And we automatized like collateral management, LTV management, and the like. And instead of like they have like to go through Excel lists and sending PDFs here and there, they can just like click into our tokenization machine and use these kind of things. And we are talking here about fundamental big investments. So there we see actually, this is like the way it's going, and we discover actually every day a new use case. And I think when we are talking here about legacy finding silos, we are always like to think about which silos will still remain, right? But maybe what new use cases will provide new opportunities for market entrance. So that's how we see the market right now.
Sure, great, thank you. So I think, I think in summary of the first few minutes, there are obviously enormous potential theoretical benefits, and we are seeing some really interesting traction from the perspective of global markets. Maybe what we do now is turn to some of the realities of unpacking about what's actually happening at the moment and how potentially we can start to reach those really quite compelling potential benefits. And maybe turning to yourself, Guido, and Emma to begin with. Guido, of course, HQLAx has been pioneering collateral mobility. You know, from your perspective, what have been the most significant breakthroughs so far, and maybe also whereabouts do you still see the biggest challenges of reaching those really compelling benefits?
Yeah, sure. So let me just start by saying that from an industry perspective, it's taken the industry longer than expected to embrace this new technology to provide collateral mobility across, across the globe effectively. But we are now really seeing some tremendous traction of actual transactions in meaningful size being transacted on a daily basis. And that is just a huge breakthrough. It's taken, as I said, longer than expected, but we are seeing it, and other platforms are also seeing it. So that's a very, very positive development, and I think it's largely driven by the regulatory tailwinds coming out of the US, where there's, we're seeing many more large global banks actively looking to embrace this technology and use it on a daily basis. We are live with a number of use cases across securities lending, repo and margining. Again, live activity on all three platforms, on all three use cases. And we're expanding other use cases as we speak. I mentioned that we are planning on expanding our product remit to enable our clients not only to manage traditional assets, but also to manage digital assets. So we see that as a huge, huge opportunity for the market. And it's meaningful. It's not only meaningful for global banks, but it's also meaningful for large asset managers who have to manage collateral across the digital asset space and the traditional asset space.
Guido, thanks. So maybe Emma, look, obviously Guido's coming to this from an SME fintech perspective, but maybe from a large institution perspective. How is JP Morgan utilizing this type of capability in traditional markets? And what do you think the challenges are in order to kind of really help other institutions come to the table to achieve these benefits?
Thanks, Anthony. So I guess framing it from sort of like a little bit of a step back, which is that I feel like the theme of the conference today and tomorrow is sort of acknowledging that actually there's quite a lot of silos in Tradfi. And what we're trying to solve for in using blockchain is getting rid of a lot of these silos. But actually that's quite difficult. My background is in new issuance bonds, and if you issue a bond in the US and you sell it into Europe, there's actually almost like a manual crossover from DTC to Euroclear. It's still really manual. And those kinds of silos are going to be quite tricky to change overnight. And as was mentioned in the last panel, we've got legal interoperability. We've also got to think about technical interoperability. And jurisdiction by jurisdiction, as was also mentioned in the last panel, is not happening at the same pace. So it's really difficult. Now, JP Morgan is obviously working on lots of individual, we've moved away obviously from proof of concept and now into production, and thinking about how we can start to use this technology to sort of make some of these efficiencies. And I'll obviously talk about the recent launch that we did whereby we can mobilize collateral on Corda versus cash on an Ethereum blockchain. Now, this is already in production and used in its billions. And I think what's key about this is sort of thinking about how this is used in tandem. It's in addition to how it's used in traditional. Nobody's forcing anybody to use this, but it's still, because it's optimal, it's being used more and more. I think that there is an understanding that, at least for the time being, there will be two almost separate silos, doing things the traditional way, however manual that may be, and then using this new technology which offers these efficiencies.
Yep. Emma, thanks. And in fact, what you were talking about is, in fact, a perfect segue into talking a little bit more about the interoperability and infrastructure challenges for which I'm going to turn to both Anthony and Tobias. So Anthony, of course, Onera has focused heavily on interoperability across networks. So from your perspective, what would you say have been the real wins so far in that space, in that interoperability space? Maybe you could touch upon why it's so important and what else is to come.
I think what many people don't understand is that, and Tradfi, and it's a good word to embrace, that Tradfi, traditional institutions, can move fast when they want to. And, you know, before I found my fintech, for want of a better word, I spent decades in capital markets technology, front office, and I saw the industry move very fast at moments in time, dematerialization through securitization, through the formation of the derivatives market. Spent many happy years at Citi taking the FX markets fully electronic and replacing traders and things like that. And I think in this space, you've seen, I've been involved for 10 years, institutions have been involved in this blockchain space. And originally it was like, oh, this thing does something with the life cycle of a securities transaction. Maybe it will solve a small problem I've got, which is a $2 billion back office every year that's costing me out of the door. Maybe I can invest in this tech and it will take a couple of $100 million out of it. That's a slow-moving proposition. Right? That's kind of, well, yes, but you need to spend 300 or 400 million and then you might get it back in 15 years' time, right? So institutions were trying to mature their understanding of blockchain, what it meant for them. What makes institutions move fast is strong business cases, right? And that's what's happening now. So what's happening right now is we've come to a place and you reach an inflection point with technology, right? I was the geek using the internet in 1987, and in 2000 we had the dot-com boom, 13 years, right? 10 years talking about this tokenization stuff, inflection points, complete about turn from the US administration, and maturing of understanding of the technologies and implementation of the technologies. You know, we've just spent 2 years taking bank-to-bank intraday repo live, right? I can tell you it was, first year was 80% tech, the second year was 80% lawyers, right? But it's doing that graft, and the reason we're doing it is because there's real benefit, real revenue benefit, not just an efficiency, not just a cost takeout. So that's the first thing. You need the business case that's going to drive revenue. How do you do it? We can solve those technology problems. And we solve the technology problems when you don't have technologists looking at this thinking, I think the problem is I've got to move this token from this blockchain to this blockchain because I've got these fragmented blockchain silos. The problem gets solved when you go, no, actually what I want to do is I want to orchestrate natively the exchange of collateral over here on a money market fund with a issuer, and I want to pay for it with a stable coin over here or a tokenized deposit account or ultimately a central bank digital currency. So for us, these projects, we've pitched the routers and routers a bit today, right? We can orchestrate these transactions across these silos. You get silos. The crypto world's almost worse, right? As we said, every Monday there's a new blockchain, right? So we can orchestrate transactions across that world. We can orchestrate transactions between Tradfi and this crypto world. But also every institution has created their own silo. They've got a nice shiny digital assets vertical sitting over here. They've still got the $2 billion back office sitting over here. I don't know how much your back office costs, but anyway, it's a good number from my experience. We can also orchestrate between those worlds. So a lot of this is how do you also take those steps forward and show institutions how they can start to instantly settle in production between these legs of a transaction in the context of then step by step taking their back office to this new shiny digital world. And in a decade's time, they might get some of those hundreds of millions of dollars back as well. But it's the business case that's making this move right now.
Yep. Very interesting indeed. Thank you. So, Tobias, just coming to you, I mean, we've kind of spoken a little bit about the realities and also the interoperability and infrastructure challenges. Does this resonate from your perspective, or is there something else going on which is kind of holding back the market? Or what would you say we need to do to start to kind of really get some traction in the space?
From my point of view, you can see it from very different angles, like this kind of question. I mean, from our perspective, we see tremendous market demand, and we don't have like real interoperability problems because, like as Emma said, like there are like legal interoperability problems. They are like technical ones. You talked about, you can always find a bridge, I think, from one blockchain to another, where there is a will, there is a way. I think when there is money movement and there's a strong demand, as you described as a business case, then this will simply happen. I think from our perspective is also like what kind of silos you want to break. What are like, there are also interoperability which you don't want to break also because maybe there's no need to it, right? So we have like, for example, like clearing houses, transfer agencies, and the like. Maybe they will be just disappearing in this new development, right? So creating like a headache around how do we connect like with an old settlement system and building like a blockchain layer on top of it is maybe not worth thinking about. Because in the end it will be replaced, but there will be definitely also silos which will remain like custodians and the like. So you have like to convince a custodian bank to use this and that blockchain, or like to get familiar with like a specific wallet infrastructure. But now they are also like very professional players in the market, like Fireblocks and others, who provide like a very simple solution to handle this kind of technical problems. So to answer your question for us, it's more like a question of business case and cash coming into the asset world. And from our perspective, when there is a huge demand for specific assets, there will be always a way to find a solution.
Sure. No. Yep. Interesting, and I really like the optimism. So, and I think again a great segue into maybe the last section of this panel, which is really about unlocking the potential we've spoken about. So there's trillions of dollars of potential value. There's clearly challenges in order to reach that, but there seems to be a lot of emerging demand as well. So I think a question for all panelists: so what is going to be the catalyst here, and whereabouts is it going to emerge in the market? And who, in fact, leads that change? So maybe I'll start with you, Anthony.
It's happened. Right? No, it's because it's not binary. You don't not have it today and you wake up tomorrow and suddenly everything's gone natively digital and you're instant exchanging all your money market funds for stablecoins. But it's happening. It happens incrementally every day. We're now live, bank-to-bank intraday repo. We started in the context that digital collateral moved by Guido's team, JP moving money in the context of tokenized deposit accounts, famous JP coin. But we're working with these parties to scale this so that you can start there. Then you can scale across onto different trading platforms. If you work in securities finance, there's only really half a dozen or more of the major trading platforms. You give people access there. Then you start to migrate and scale the cash leg, so we can move from a tokenized deposit account maybe at one commercial bank to another, but also to a stable coin on public chains, be able to send and receive between digital custodians and orchestrate those transactions. And then you can start to move to different sources of collateral. I've been spending a lot of time with DTCC recently. And so it's happening, and it's happening incrementally every day. And I think the really exciting stuff is happening there, actually. DeFi's great, right, down here in crypto land, but it's kind of running into scaling issues because there's reasons why institutions are having trouble going there. But we see this happening top down with the tier ones, buy and sell side, and then that's going to like a waterfall, and it's going to cascade through the financial services ecosystem. So it's already started.
Sure, absolutely. I mean, is that lining up with what you're seeing, Emma?
I mean, I think so. I think the catalyst obviously depends on who you are. And I think it comes down to sort of the main theme that Tobias was talking about, which is your own business use case. Using this technology often sort of falls into two brackets. One of them is being able to offer you and something that you can only do using blockchain. And, you know, I think that the intraday repo is a good example of that, because you can use the settlement time on that only blockchain offers as opposed to overnight. And then the other one is around operational efficiencies. And I think that was sort of one of the things that sort of started the evolution of the digital bonds was the sort of concept that an issuer, instead of having to issue and then settle 5 days later, they could issue and then settle 1 or 2 days later, which again, in times of market volatility, would be incredibly useful if you're an issuer. And I think that what has happened over time is now perhaps there's more of a convergence, merging both of those things into sort of collateral on chain, but also, you know, the buy side have got different use cases, and we've seen a lot of different examples of how they want to use this technology. And I think one of the key things is that with the new administration in the US and sort of like the huge tailwinds that we now see and that we weren't necessarily talking about a year ago, lots of institutions are starting to think about this technology and how it might work for them. And those tailwinds are just making the conversation so much easier, because instead of it being a battle and a pitch and having to try and prove to somebody why we think this is such a good idea, we're now having sort of the incoming conversations of what should I be doing, what do you recommend? And I think that will help, because once more people sort of across the financial services industry are educated in this, they're not scared of it. They don't see it full of an industry of bad actors, which for a time I really felt was the case. More people will then be inclined to use it because they'll be able to see the benefits from it. And, you know, that perhaps wasn't the case sort of a year ago. Definitely it wasn't 2 years ago.
Yeah, great, thank you. So, so we're going to wrap up the panel in a couple of minutes. And before I come to you, Guido, for some final comments about the future, maybe Tobias, you know, from your perspective, what changes would you like to see in the market to really accelerate what STOKR's doing?
We would like to see more adoption of stablecoins in Europe, and I think with like the MiCA regulation and the regulations we have in place, we made a big mistake, and I think Emma mentioned the Genius Act in US, and with this one, I think there was like somebody asleep. It was a big dragon, and now it's awake, and it's really vital, right? And US is going like with full force, and there's like a lot of cash going on, a lot of innovation is happening right now in US, and I think we are like on the brink in Europe, including maybe even UK, to miss the train. And so what we would see is like a little bit more openness to see what is really like the reality out there, right? In a very simple sense. And I like to create a little bit of FOMO also. So I think we should not just like watch and see it happening, because maybe like some financial centers will not have the importance anymore in the future when we miss this train. So that's what I would like to see, that we discuss stablecoins, and I think banks are also demanded like to look at this specific space, because without you know, an asset tokenization leg needs a cash leg, and this is also the most promising way of instant settlement and finality in the end. Yeah.
Tobias, thanks. So maybe to finish with you, Guido, whereabouts are we all headed in this space?
Where's my head? That's a scary thought. No, maybe just I'm just looking at the title of the panel. Can tokenized assets be traded between TradFi silos? And the answer there is definitively yes. Okay, and maybe I can just spend 2 minutes in describing how the HQLAx operating model works, and at a very high level, just so it makes conceptual sense. And it should also then clarify, you know, how we are currently tackling collateral mobility in the TradFi space. So we partnered with a global custodian in Luxembourg called Clearstream International, which uses our distributed ledger technology built on Corda as its books and records to track and to transfer ownership of securities that are sitting in its custody and sub-custody network. Now that sub-custody network includes the preeminent collateral locations around the globe, including JP Morgan Tri-Party, Bank of New York Mellon Tri-Party, Euroclear, Clearstream Bank Tri-Party, Citi and BNP, and we're adding more custodians. So these are all traditional custodians. And our clients who hold assets at those custodians are able to on-ramp securities in those locations onto our platform and then transfer the ownership of those securities to a counterparty on a 24/7 basis without those securities ever needing to leave the safekeeping of that home location. That's the bottom line value proposition of what we're doing in the traditional asset space, enabling our clients to transfer ownership of traditional securities without needing to move them from one custodian to another. It sounds pretty basic, as I'm listening to myself even say these words, but the underlying value proposition is tremendous. Now, the value proposition going forward, and here's where it gets really exciting, is that I think we should add DeFi to this thing. As I mentioned earlier, collateral management is not only about managing traditional assets, it's also about managing new and upcoming assets, so cryptocurrencies, stable coins, tokenized money funds, and tokenized deposits. And at some point in future, global banks will need to manage those collateral obligations, but so will other new participants to the market. So the underlying theme is the idea around collateral mobilization is not just an idea, it's happening as we speak, but the value proposition is going to do nothing but become stronger over time as we expand that value proposition not only to include traditional assets, but also to include DeFi assets.
Brilliant. Well, I think on that we can finish, but thanks to the panelists, and thanks for everyone for paying attention. Thank you.